Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Wednesday, the 17th of September, Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. Before we get into it, just I didn't point this out on Monday. Not even shouting about my own stuff. So we dropped the number of days to pass from 7 to 5 days on new accounts as of the weekend, this weekend just gone. So if you sign up, if you signed up before then, it was 7 days will still apply to you. Any sign up since the weekend just gone are now subject to only passing in 5 days, and we're still at 30% off with no activation fee. The code is no fee 30. Okay, with that out of the way, we're going to take a look at our regular stuff in here. What we've got coming up. Not a huge amount to focus on because it's all about the Fed, really. But I just want to look back before we start looking forward to yesterday's retail sales data. So yeah, core retail sales and headline retail sales, both beating expectations. Expectations were 0.4 on the core, came on the month-on-month, came in at 0.7, and 0.2 on the headline number, coming in at 0.6. So both beating notably. Market haven't been rallying, stock indices rallying really for the last week or two, and making new record highs. Didn't really go anywhere. Now, partially, I think because we've got the Fed today, so the market's not going to make a big move ahead of a big announcement and a big, first rate cut likely, very, very likely of the year. But also, I think we've got a little bit of here where the market is unable to rally on positive news because of the anticipation then it might mean the Fed are not as dovish. So it's kind of counterintuitive. So good news for the economy. So retail sales being up is good. It means people are spending. It's good for the economy. But then that also means if the economy is doing better than we previously thought, then maybe the Fed won't be as dovish. They won't cut as aggressively. And the stocks are now pricing in a more dovish Fed. So sometimes we get to this point where when the data is slightly better than expected, stock indices don't actually go up, or they initially go up and then they jerk back the other way because the anticipation is, well, it's going to change what the Fed are not going to be as dovish. And then we'd rather have the economy slowing slightly or not as strong and have interest rates lower. The stock indices and individual companies would prefer that to some extent. So it's interesting the way that plays out when we get to this kind of pivotal point when the Fed are starting to make a move. And then we look at the data, and it actually means that good data can sometimes mean a negative result for stock indices. So watch that going forward as well. I just wanted to highlight that as something that may have happened yesterday. It's probably also to do with the fact, though, that we've got a huge piece of data today, so the market is not going to make a massive move on having been rallying anyway. It's not going to go massively higher yesterday ahead of today. So stocks were a little just faltered really, and just marked time for a little bit yesterday, but sat right up at those record highs. Looking into today, we did get some inflation data out of the UK and Europe in here this morning. The UK data bang in line, you see in black in here with expectations. The year-on-year number out of the Europe in line, but it's in red, meaning negative for the currency for the euro, but that's actually positive in that it was the CPI data in here, the month-to-month and the year-on-year data. The headline numbers were down on the expectations, so that's a positive, lower than expected. Excuse me. Going into today, although all eyes are on the Fed, we'll talk about the Fed in a minute later on today at 2:00 Eastern time. We do get the Bank of Canada earlier on today. So we get the statement and interest rate decision at 9:45 Eastern, and then the press conference at 10:30. Expectation that the Bank of Canada will cut rates as well. 25 basis points, 0.25. That's the expectation from the Fed as well. And we'll move on to the Fed. Expectation of a 0.25 interest rate cut. Critically, the press conference comes half an hour later, so 2:00, the decision, the press conference, but also the statement. We're going to be watching the statement, but really critical, is going to be these here, like the interest rate projections. and the economic projections. So what we're talking about here is what we call the dot plot chart. And that comes at every other meeting from the Fed. So I'll actually put not just dot plot chart, let's put Fed. Otherwise we're going to get a random dot plot chart. So in here, this was from June 2025. And this is really, so these are like the economic projections where they see GDP, unemployment, etc. Okay, but the really one the market focuses on is this one here. So this is where the interest rates are. So these are at the end of 2025, where we expect them at the end of 26, and then you see where the kind of the mean is on this, right? So back in here, this was the June 18th meeting. You see that we had the mean is around in here, like the 4 to 425 we expected by year end. Okay, 4 to 425 was the expectation back then. So we're going to be looking, we can actually see what it is at year end, at the end of 2026, at the end of 2027, and longer term. And we can see where the consensus, each of these dots is a vote by a member of the Fed. Okay, and then you see they're sitting in between the lines, because remember the rates are a band, right? So the band, rates, a current target rate is 425 to 450, and we're expecting a rate cut to the 400 to 425 band. Okay, so that's why you see them looking like that. So we're going to see them in between the lines in here. That's what's going to be critical. I think we'll get the market's going to be watching that. Where is the consensus for the end of the year? Where's the consensus going into 2026 for the end of 2026? What I'm doing is I'm just going to jump to the Fed Watch tool. So, we've got 100% chance built in of a rate cut, 6% chance we actually get 50 basis points. Very, very, very unlikely. But if we go to the October meeting now, we're pricing in what's this, 78% chance, less than a 22% chance that we get a second rate cut here, and an outside chance we get a total of 75 basis points, 4% chance we have 75 basis points in the next across the next two meetings. And by the December meeting, if you look here, 70, 74, so 75% chance that we've had three rate cuts. So, and you can see it actually is three rate cuts. There's only a very outside chance that we've got 100 basis points. So the market is looking effectively for rate cut for the next three meetings. So let's see if the dot plot chart tells us that. My feeling is, and this is just kind of guesswork, I think the Fed will be sitting somewhere between 2 and 3, and there could be a chance that it only shows 2, and the market will probably be a little bit disappointed unless the tone is, I think the market wants the tone to be very dovish from the statement. I think they want the tone from the press conference with Powell to be very dovish, and I think they want the dot plot chart to definitely show 3 rate cuts. And if they only see 2 and a half, chance between 2 and 3 rate cuts, I think the market might be a bit disappointed with that. And on that, you could actually get a rate cut and pricing into an indication of a rate cut and an indication of only 1 more between the end of the year. I think the market will be disappointed and stocks could go down on that. So just be wary of that going into the day. So just going back to where we were, so all eyes really. So just, keep an eye on, but it's not going to really impact the major stock indices in the US of Canada, the Bank of Canada, but really all eyes on 2 o'clock and then 2:30. Remember, markets will be shut down 2 minutes before and 2 minutes after. So 2 o'clock, 1:58 Eastern through 2:02 Eastern, we will close markets down. No trading over those major data points, and the Fed meeting being one of those. So this is the morning briefing America. TikTok buyers unveiled before key Trump Z call. So anticipating that going into this week is, I think, the idea. Friday, key phone call on Friday. Trump might get the rate cut he's wanting for. The president's looking for a big cut. That's not going to come. That's not going to come. We're not going to get 50 basis points, in my opinion, in the market's opinion. And then Trump is in the UK. You're right. He actually flew into Stansted, which is not too far from where I live. He flew into Stansted last night with Melania, so they're on a state visit to the UK. So, might get some announcements regarding UK-US stuff, but nothing to really impact US equity indices. Stocks stalled yesterday. Not really much going on this morning on the overnight as traders shunned risk before Fed call. So markets in wait and see mode. US stock futures subdued as caution prevails before red. Nvidia slips. Fed rate cut to mark pivot towards the job market. So what does that mean? Well, they're basically saying that job market is now going to be the focus of attention. Is the job market deteriorating, which then would lead to deterioration. The job market leads to deterioration with the consumer as well, and then a slowdown in the economy. So focus more on jobs. Having been obviously the focus previously been shifting from being on inflation towards the economy and towards jobs. So employment's going to be key going forward, jobs data. Traders boost bets on half-point Fed rate cut by year end from the bond markets. Bond traders stepping out option wages at the Federal that would deliver at least 1 half-point interest rate across this year's 3 remaining policy meetings. Markets pricing in, though, as also 3 on the FedWatch tool, 3.25s. US mortgage rates down as well, fall to 2044 levels, fueling refinancing surge. European shares up as investors await. So European shares actually up this morning. And if we do a run around global indices, the Nikkei slightly lower this morning, 0.25%, but the Hang Seng significantly up 1.8%. European exchanges, well, it says they were up. UK FTSE's up. DAX slips back a little bit now, down 0.1%, and the CAC actually down 0.25%. And US indices, on the overnights in here, you can see pretty much unchanged. S&P and NASDAQ hardly changed overnight. We've already run through the FedWatch tool. Won't go through that again. As we said, yields lower in here, 10-year yields right on recent lows. And arguably, apart from this blip, the lowest point since October of last year, so October 2024. US Treasury is looking really bullish. 30 years, you can see right up on recent highs at the top of this big channel. So US 30-year bonds in here. Remember, higher prices equals lower yields. So 30-year bonds up, 10 years right near the highs. And even the 5 years rebounding from around this trend line, having been more subdued, setting back in 2 years as well. The shorter end of the curve has rolled back a little bit after initial exuberance for rate cuts. Remember, the short end of the curve, more a reflection of interest rates and rate expectations. The longer end of the curve, 30 years, 10 years, 30 years, more of a reflection of the economy. And indices pretty much just hovering just around the highs, the more recent highs. So both the S&P and NASDAQ made new all-time highs last week again, and at the beginning of this week. And then yesterday, just kind of cautious, just consolidating, going into the Fed. All right, guys, I'm going to wrap it up there. So all eyes on the decision and the dot plot chart and the statement at 2:00 Eastern, and then the press conference at 2:30. I'm going to wish you all a great trading day. Take care, stay safe, and we'll be back with you to pick the bones out of what the Fed have done tomorrow on tomorrow's webinar. Bye.